Okay, well, the initial impact is, of course, negative because you've got so much of the economy closed down, people not being able to do what they would normally do. So definitely a negative in the short term. But unlike the lockdown we went into last year nationwide, we now know what happens sort of in a lockdown. And as soon as one ends, and once it ends, we catch up on a lot of the spending that we weren't doing. We dive into the housing market. And I think especially knowing that, a lot of people, quite frankly, are going to take advantage of this time to accelerate the searching they've been doing with increasing momentum over the past 3 months to be looking for houses again.
Welcome to Tea with Tony, lockdown style. At the time of filming, New Zealand is 1 week into COVID lockdown. Everyone seems calm. There's almost a sense of we've been here before. We're hoping we can all come out and buy spa pools again soon. But what's the economic reality of our current situation? And what if there's a prolonged lockdown in Auckland? Hi, Tony, how are you?
Good, thanks, Lenska. Good.
Right, we'll rip straight into it in our very kind of slightly different world of Tea with Tony this month. What's your take on our current state and its potential impact to the economy, but also kind of everyday New Zealanders?
Okay, well, the initial impact is, of course, negative because you've got so much of the economy closed down, people not being able to do what they would normally do. So definitely a negative in the short term. But unlike the lockdown we went into last year nationwide, we now know what happens sort of in a lockdown. And as soon as one ends, and once it ends, we catch up on a lot of the spending that we weren't doing. We dive into the housing market. And I think especially knowing that, a lot of people, quite frankly, are going to take advantage of this time to accelerate the searching they've been doing with increasing momentum over the past 3 months to be looking for houses again. So, the Reserve Bank, they've still indicated they've got to be putting interest rates up soon. The Finance Minister is saying the economy still has some fairly good momentum there. So, we're basically looking at just a temporary interruption to the economy, not a prolonged sort of deep recession situation.
So what about risk of a prolonged lockdown in Auckland and, businesses being affected, hospitality workers? There's still a little bit of that risk, isn't there?
Yeah, well, definitely, given the Delta variant, we could never be certain exactly how long it's going to take. I suppose for New Zealand, we're just too far away from high enough vaccination rates to have reached the point of saying, we're now going to have to let this thing in and handle it, through the hospital system. That's the point we're going to have to get to, but we're not there yet. So, definitely there is that risk up in Auckland. And if it happens, then economic activity will be weak again for a while, but the rest of the country will, I guess, be barreling along. And we'll simply have to take it as it comes. But we've been here before. Auckland in particular has been here before and recovered each time pretty strongly afterwards. And I think that's the expectation most people and the policy makers will have. This is a temporary interruption, whether it's 2 weeks or 4 weeks or whatever, it is temporary and we will pop out the other side.
You mentioned interest rates. Adrian Orr and the Reserve Bank, it's very well publicised. You talk about it in Tony's Thoughts this week, actually. They hit the pause button as opposed to, a very predicted interest rate increase. My question to you is probably the right thing to do given Delta, or a bit wimpy given that they know about the underlying strength of the economy?
Yeah, probably the right thing to do. Initially, I didn't think they would pause when it was just one case, but as soon as we saw the extra 4 or 5 cases announced the next morning, it became fairly clear that they would have to just put things on hold for the moment. And that's what they said, but they also made it very clear the economy is growing faster than it can actually handle. We don't have the people, we don't have the resources generally. Inflation is 3.3%, the unemployment rate is 4%. We've just learnt retail spending volumes grew almost 3.5% in the June quarter. So, the economy's growth rate has to be slowed down. And that's where it's interesting because I've already said, this is going to be damaging for the economy in the short term. So one might think, but surely this will reduce pressure on the Reserve Bank to raise interest rates because the economy is being damaged. Well, no, we've actually got low interest rates for 6 weeks longer. So a continuing stimulus to the housing market for longer than anyone had been thinking. And we're all reasonably confident of getting this under control. And then we will run out again and get another spa pool or gazebo and kayak, etc. So the Reserve Bank has signalled they're definitely raising interest rates, and they've actually increased how much they think they'll need to raise them by from 1.5% to 1.75%. I still think we're looking at a range of 2 to 2.5% going on top of what people are being recently paying for the likes of, that 1 year fixed mortgage rate.
That segues really nicely into the housing market and house prices. Are you seeing any, and it would be anecdotal at this stage, I'm sure, but any evidence of a reduction in demand due to Delta?
Too hard to say when we simply don't have data broken down on a weekly basis. I would think there'd be a minor pullback in demand, but everyone's seen what happened after we had the first lockdown last year. The market went ballistic after that. Now, we're not going to do that this time around because we don't have a fresh slashing of interest rates. We don't have the removal of the LVRs. We've got the interest rates in the marketplace, the mortgage rates, some of them have already gone up. The Reserve Bank says it's definitely going to jack them up when it gets, a bit of a clearer picture to do it. The LVRs are back and stronger than before. The Reserve Bank has now got extra power to impose, debt to income ratios, and are fairly clearly signalling they're probably going to do that. They strengthened the LVRs by reducing low deposit lending ability for banks just a bit further recently. So, I certainly don't think the market's going to be shooting off the other side. But one key point to note is that although we saw the market being shocked by March 23 tax announcements, and things were at their weakest maybe around April to May, but over the past 3 months, extra momentum has built. We've seen FOMO going up again. We've seen fewer investors looking like they're going to be selling their properties. So we've actually got accelerating momentum in the housing market. And I think that means people who were looking before lockdown are still, I'd say, looking right now in their screens, looking for something.
And there's a lot of people, my understanding, there's a lot of people at home they're at home now and they're looking at property, so it becomes a bit of a national pastime. So there's a lot of, my understanding in the real estate market, there's a lot of interest. At an NZHL level, we had a bit of a spike in loan applications last week and have had a little bit of cooling, but still buoyancy. So yes, people are still sniffing around. It's our national pastime, it would seem. Adrian Orr says that there's a supply and population growth are now going in different directions. He takes it a step further, and it's quite different to what you're predicting, just quietly. He says that they estimate, the Reserve Bank, a 2 to 3% reduction in prices per year from late next year for 2 years, sort of totaling around 5%. So a correction. And they're basing that on the whole supply catching up, migration coming down. And then he says afterwards that migration, these are best guess estimates. So it's all guesstimates, but your stuff, you've been talking to us for quite a long time about continued growth in the housing market. Your projections around that, particularly this year, which is, he's saying the same thing, it's next year. What's your take on that, out of interest, on a potential correction end of next year?
Yeah, I don't see the house prices falling at a national level because generally that only happens when we've got a recession in the economy, which has been preceded by very high interest rates. So I don't see that as happening. But he's definitely correct when he's citing things like slowing population growth, booming house supply. Also, of course, the interest rates are going up, the tax changes coming along. My message to people has been very, very clear that we can't continue at the pace of increase in house prices of the past 30 years, 6.7% per annum, or obviously the past year of about 31% or so. There's definitely a slowdown coming along. So he's right to say that. But virtually every forecast in the past 3.5 decades of falling house prices has been wrong. And I think the governor is well aware of that. And when I read what he was saying, I got the impression that he probably wishes he hadn't actually mentioned that house prices might go down by 5% because these forecasts have been wrong simply too often. But no, the factors they're citing are quite correct. People should not be projecting house prices will rise for the next 1, 10, 30 years at the pace they have increased over the last 1, 10 or 30 year periods. Yeah.
What you're saying is you're not expecting a repeat of 30% house price increases on the back of the last lockdown, given, this time the market doesn't have it in it, does it?
Exactly right. If you go back to the start of the boom, I guess early 1990s, the ratio of household debt to household income was about 60%. Now we're looking at 167%. Things will slow down, and the thing that's principally going to be causing the slowdown in the next 2 years is the removal of record low interest rates. It's coming along, and people just have to accept that.
Look, with that in mind, and it's hard, I always preface this with you and say you're not a crystal ball gazer and you're not a magician, you're just an economist. What would your guidance to purchasers be right now? And you're not a financial advisor either, by the way.
Yeah, no. Okay, my advice to people would be get proper advice when it comes to managing your mortgage from mortgage advisors, obviously. To note that people are shifting the term, they are fixing their rate. It was all 1 year that people were fixing it for a great number of years. Most people are looking at maybe the 3-year period, and those rates generally still seem fairly good at the moment. 5 years is still a bit too expensive for most people, even though it was my favourite there for an extended period of time. And when it comes to the market, look, I know there's a lot of young people out there who are really stretching their resources currently. They're borrowing money left, right and centre from everyone they know, all the relatives, etc., trying to get into the market. But honestly, listings are extremely short. The government wants house price inflation to flatten out. There's a lot of potential vendors who have simply been hanging out for higher prices, and it's been a brilliant strategy. But at some point, the investors who want to sell, you know, they want to get on with their life, they're going to go, yeah, nah, it is time now to be selling the property. So at some stage, listings will improve. And so maybe for some first home buyers, it's time to just step back, wait for the interest rates to go up, wait for the government to, I think they're probably going to do something more on the investors. The Reserve Bank, I think, certainly is going to. And I would expect one big change for next year and the year after will be the listings will improve, and eventually more sections become available for those who want to build.
Yeah, and look, that's hard for young people who genuinely want to start their lives and have a family. So there's that balance to that. And I mean, look, there's locations that are still reasonably undervalued, like Christchurch, which is what we've talked about before. But there's also LVR changes coming in October, aren't there, Tony, that are going to restrict the amount of available lending further for people with less than 20% deposits. So that's something we work with a lot of first home buyers. And look, we were going to I know you've got some work coming out. You've done a survey around managing interest rate rises that you're going to share later. I will say, to close out, that's kind of what NZHL do, and we work with, and you've been around us long enough, Tony, to know this, that we work with a lot of first home buyers around kind of managing what you can control and building in your rates increases and your challenges and setting yourself up for success early. So there are ways of doing it, and it's not always rocket science. It's the simple stuff that matters, is the truth, and getting the right support and the right advice. So look, I guess our takeout today, if I'm hearing you correctly, is no need to panic. I don't think anyone's panicking, is the truth either. And this is a temporary reset, even if there may be some further economic challenges if Auckland, I think, particularly in hospitality sectors and things like that, if Auckland stays in lockdown. Any kind of major other outtakes for people?
Yeah, use this period, I guess, to gain some insight into where you can save some spending. Once the interest rates start rising, people are going to be thinking, what can I cut back on? You're doing it right at the moment. You're making your own lunches. You're not eating out. You're not getting all the coffees each day. And of course, 7 weeks of lockdown last year, people popped out with bigger deposits. The first home buyers realised, oh my goodness, if I keep this up a little bit longer, I can get myself into the housing market. And just two other things, that there's a shortage of labour around the country. So once the interest rates start rising, people will be able to pick up some part-time work to supplement their income. And there's a shortage of accommodation. So there is quite strong scope to bring in a flatmate or a boarder as well. So I don't believe the increase in interest rates when it really gets cracking is going to, greatly depress the economy, because people have some ways to raise their income slightly, and we've all got some ways we can cut back on spending after a few years of being reasonably profligate, I guess, in our spending in a low interest rate environment, which is now ending.
I'm still saving up for my spa pool, Tony.
Stick in there. Yep. People are going to be selling them off fairly soon, some of the portable ones, once they need to free up some cash, maybe in 18 months' time.
Look, thank you very much. I hope you're safe and well in your little bubbles, and we'll see you next month.